Hi guys, welcome back to the YouTube channel. In this video, I'm going to run through how to pay yourself from a limited company as a director, as a shareholder in 2024, 2025, the current tax year. So the first place to start really is all about the income tax bands because this is what you need to kind of understand to make sure that you don't end up paying higher rates of tax as income falls into different bands. But everybody, you'll get your personal allowance, and that's £12,570, and basically this is always going to be tax free. And then the next £37,700 is basically called your basic rate band. And together, these two make up the 50,270, which for most people is a pretty tax efficient amount to take out from your company. And income that falls within this 37 will be taxed at 20%. If it's employment income, salaries, and whatnot. If it's dividends, 8.75%. And then the next amount up to the 125,140, 40%, 33.75%, and so on. So as I mentioned, the 12,570 personal allowance, it's important to mention that this is withdrawn when your income goes over and above £100,000. So it's withdrawn by £1 for every £2 of income over 100k, and when you get to 125,140, it's fully withdrawn. You've got your £500 dividend allowance. This has gone down massively. A couple of years back, it was £5,000, then 2,000, then 1,000. Now here we are, 2024, 2025 tax year, and it's just £500. It's small, but still worth mentioning. You've got your £1,000 personal savings allowance and £500 if you're a higher rate taxpayer. It's 1,000 if you're a basic rate taxpayer. And then you've got your £5,000 savings nil rate band as well. So the first £5,000 of interest that you receive, that will benefit from its own 0% tax rate. National insurance, a couple of different limits to note. The first is the lower earnings limit, and this is 6,369, and you have to earn at least this much for it to count for pension purposes. So it's always worth paying a salary of at least this much for it to be a qualifying year if you want to rely on the state pension when it comes to your retirement. And then we've got the primary threshold, which is 12,570. Again, with the personal allowance, those two numbers are mirrored up now, which is nice and easy. It wasn't the case until a couple of years ago. And this is your employee's national insurance. This is what you would pay as an employee. This is 8% on up to 50,270. And above that rate, it reduces to 2% on anything above that. Secondary threshold of 9,100. This is employer's national insurance, so what your company pays, or you as your company employing yourself. And this is 13.8% with no change regardless of the amount of salary. So if you want a high salary, if you're employing people, you want to know just how expensive this tax can be. But most businesses with more than one individual on PAYE will actually qualify for the employment allowance, which covers £5,000 worth of employer's national insurance each and every year. Corporation tax, well, this is paid by the company on profits for the year. Typically, profits is revenue less all of your allowable expenses. Again, you can do other things such as pension contributions. These can reduce the profits, and as such, corporation tax as well. It's important to note that salary payments and any national insurance is actually tax deductible expense. It's going to reduce how much corporation tax you pay in the company. The rate of corporation tax does depend on a number of factors, including other associated companies, with all of these thresholds being divided by other associated companies. But broadly, it looks something like 19% on the first £50,000 worth of profits, 26.5% on profits between 50,000 and 250,000, and then 25% on profits over 250,000. Paying dividends. Well, dividends are actually distribution of profit paid to shareholders, not necessarily directors. I've added it in there because often there's confusion about, should I make this person a shareholder, make this person a director? And actually, you have to be a legal shareholder, somebody who owns the shares in order to receive a dividend. It's very different to being a director, where actually that's just kind of it's an office, it's a type of employment, and that's why a director gets paid a salary. Usually in a small business, they are the same person, but it's not necessarily the case. So you don't want to have somebody as a director and it gets into the tax and you say, can we pay them dividends? Well, actually, you can't because they're not a shareholder. So we have to look at how we plan for that. The company must have sufficient reserves. So by this, it means that if you've made profit, if you've made nothing but losses since the business has been incorporated, well, actually, you can't usually pay out dividends. You have to be able to show that you've got positive reserves, you've got profit in the account in order to legally take a dividend. And for anybody who's in the property space, if you've got fair value gains, whilst it might show that your balance sheet looks healthy, if they're in the non-distributable reserves, they're exactly that, non-distributable. You can't use them to pay dividends. They can be declared any time during the year as an interim dividend, and it's best to do this so you have flexibility. If you declare a dividend as final, that's it, it's final. You can't then cancel the dividend or change the amount if you need to, whereas with interim, you can. And these dividends are subject to income tax rates on the rates previously mentioned. Paying interest. If your company owes you money, it's a great position to be in. You can charge a market value interest rate on this loan. This is subject to income tax in the same way as a salary, but there's no national insurance. And it's even better to mention here with dividends. Dividends are paid post-tax. Your company's paid the corporation tax, and then whatever's left, it can pay out as dividends. So for this reason, paying interest is always the first route to go. It's the best route because with a salary, yeah, it's tax deductible, but you pay national insurance. With dividends, you actually pay the tax first, and then you pay dividends at a lower tax rate. Whereas with interest, it's tax deductible. Yeah, you pay income tax on it, but there's no national insurance. So with this, you do get the benefit of the savings nil rate band plus the personal savings allowance as well. But it's also just worth remembering that each time you do this, when you pay interest, usually annually, you have to file a CT61 tax return, withhold 20% tax, pay it over to HMRC, and reclaim it on your personal tax return. So, what's the tax efficient salary if there's no loan element involved? So, for most people watching this will probably be the case. Well, it's quite simple on reads. You want to take a full salary of 12,570. There's no income tax on this as it falls squarely within your personal allowance. No national insurance as well because it falls within that band. There could be employer's national insurance on the difference between 12,570 and 9,100 at 13.8%, but usually this is covered by the employer's allowance. But even where the employer's allowance is not available, it's still worth taking this higher salary as the tax saving you achieve by paying that higher salary and actually reducing your corporation tax at a minimum 19% is obviously greater than the additional cost of the company of the 13.8%. So that's kind of how those tax bands work. Yeah, you are going to pay a little bit more tax in the company at 13.8% initially, but actually when it comes to deducting this off your profits with a higher salary, you are still going to be saving tax here. Anything over and above this, look to take as dividends. Total income tax on £50,270 would be about £3,255 there. So this is if you've got a loan, so a small loan, obviously the numbers can change depending on your specific circumstances, but we've kept it nice and simple here. So again, take that full salary. You might as well, you keep your pension entitlement, and then any interest, so take interest to say £6,000 to keep the numbers easy and use those bands up. That falls squarely within the savings nil rate band and personal savings allowance. So that £6,000 is completely tax free. Dividends on the rest up to the 5270. Total tax in this case falls to just £2,730. And also, this is personal income tax. Let's not forget that £6,000 has actually received corporation tax relief as an allowable expense in the company, and that's going to save you a minimum of anywhere between £1,200 and say £1,500 in the company because that's going to reduce the corporation tax bill. So paying your partner, if you're married, have a spouse, etc., can they be involved in the business if they're not? Look to potentially bring them in. If they have low or no other income, this can bring a huge saving where you regularly take over the 50,270 yourself and pay tax at the higher rates. As a minimum, can you pay them a salary of the 12,570 if they do some work, some admin, a little bit of help here and there? Because if they have no other income, they will pay no income tax at all for having that salary, falls within their personal allowance, and your company will actually save £2,388 as a minimum because that salary is tax deductible, and then you've also extracted 12,570 out of the business, which can be used to meet living expenses. You can also go one step further than this, look to create alphabet shares in the company to allow them to have different levels of dividends. Even just using their £500 dividend allowance can be a good option. But if you are regularly taking more and your spouse, your partner is actually squarely within the basic rate band, it makes sense to put some dividends on their tax return effectively, put some where they're paying tax at 8.75%, so that they're not in your tax return where you're paying tax at 33.75%, 39.35%. If you do that, you can be saving minimum 25% income tax there. So some admin each month when you submit PAYE, you need to submit PAYE to HMRC and you need to confirm what salary payments have been made, any taxes that have been deducted. Usually you'll do this even monthly. With the PAYE submission have to be in every month, but when you actually pay the PAYE to HMRC, you can do this monthly or you can do this quarterly. Most of the time, quarterly if you're a small business. It obviously makes it easier from the admin side. Remember the CT61 on the interest payments, and make sure that you do budget for income tax on dividends. What you get, all of it isn't yours. If you're in a higher or an additional rate taxpayer, what you actually get, a third of it could be due to HMRC when it comes to make those payments on account or do your tax return. And as always, check the specifics with your accountant to make sure that anything we've mentioned in this video is 100% right for you. If you want to work with us at JSM Partners, we're award-winning chartered tax advisors and accountants that work with property investors and entrepreneurs all across the globe. Head to jsmpartners.co.uk and book a free call with the team. Bye for now, guys.